Monday to Friday at 12:30 p.m. only on Bloomberg Quint.
Thanks for tuning in to Alpha Moguls. My name is Neeraj Shah, and over the next 30 minutes, we'll speak to an investing mind about how he is navigating through the next 12 months or next 24 months, and what's the investment thesis in a market scenario like this. It's the first episode of Alpha Moguls of 2019, and with me a very special guest to take us through it, Hiren of Alchemy. Hiren, so good having you. Thanks so much for joining in.
Thanks, Neeraj. Thanks for having me on the show.
Pleasure having you. Now, just a few bits that I would want to talk about, Hiren, and what Alchemy has done over the last few days, weeks, months, and years. The performances that they've given in, and they've beaten the market, the benchmarks, and maybe peers as well, quite handsomely. 1 year returns, the benchmark BSE 500, negative about 0.4%. Alchemy is given a return of 2.8%. 2 years, they've beaten the 13.5% benchmark return by delivering returns of 18.3%. And the statistics go on. 7 years, 23.7% returns since inception, which was 10 years ago. They've given returns of 23.1%. The BSE 500, the benchmark, the relevant benchmark in this case, has given returns of 14.6%. So quite a staggering performance, Hiren. And we can look at 10 years and think about how good it has been. But I think the more pertinent thing to do would be to also look at how the last 1 year has been full of turmoil. Most people are underperforming. How is it that Alchemy has done what it has done? What did you do which helped you clock in this performance? And of course, congratulations on 10 years of Alchemy.
Well, thank you so much. It's actually not 10 years for Alchemy. Alchemy, our oldest product is actually almost 17 years old, but a strategy that I run personally just completed a 10-year track record where we essentially manage very concentrated portfolios of 8 to 10 companies, right? Yeah, I mean, you know, the 10-year performance has been good. I would say we've been lucky as well. Having said that, I think 2018 was a tough year. Somewhere, you know, by end of 2017, 2018, we got a sense that the markets were getting a little euphoric. You know, especially valuations in the small and mid-cap space were just completely out of whack. I mean, we look at this gauge regularly, which is we look at the trailing PE multiples of the Nifty and compare it to the CNX mid-cap, right? Not the future multiple, forward multiples, because there is always, you know, expectations could either be high or low about the future, but trailing is all in the numbers, right? And it just gives you a sense of where the risk appetite is and what the valuations, etc. are. And this mid-cap index was trading at a 2200 basis point premium to the Nifty. Long-term averages are like 200 basis point premium to the Nifty, which was trading at 10x that premium in the beginning of the year. So something clearly was wrong. And so we systematically reduced our exposure to small and mid caps very early into the year. Not that some of our small mid caps did not correct like for everybody else, but they corrected less than the average, and some of them that corrected have bounced back pretty well, right? So we changed our positioning a little bit, and you know, we thought that the small mid caps have had a phenomenal 4 or 5 year run from the bottom in 2013 to the peak in Jan 2018. And a lot of money has been raised in small mid-cap funds in 2016-17, largely in 2017 and 18, and all in close-ended, you know, strategies. So I think that there was a little bit of this self-fulfilling prophecy that went into, you know, people liking the long-term stories in some of these companies and kept on buying the same stocks at higher and higher prices. And we've seen these cycles before, right? And I think when we tell clients that one of the things that we bring to the table is, 17, 18 years of track record, what it means is that you've seen several bull and bear market cycles before, so you don't tend to make the same mistakes. Our setup in 2018 was something very similar to what we saw in 2013 second half, right? Rupee depreciated, current account was in stress, small mid caps got smashed, there was elections in 6 months, we had a new RBI governor, Rajan, who came in, and then you switch to 2018 second half, you have something very similar, right? Fed raising rates, you have a small mid-cap overvaluation which started to come down, and the trigger point came when SEBI changed the reclassification of the mutual funds, and then the ASM framework was brought into place. But those were all alibis. I think it was just that there were a couple of stocks which were just too overvalued and they had to correct, so they did that. Well, and then the nail in the coffin was the IL&FS crisis, right? So if you really look back at 2013, the low point of the market was in August, September, very similar to this time. So I think to some extent that context, which we saw in 2013, was something that was in our mind in 2018. So, wherever, even though we have a fair share of mid caps in our portfolio, but wherever we saw a chance that there was at least a near-term overvaluation, we kind of took some money off the table, we reduced our exposure, and incrementally we've invested in sort of some large cap non-consensus trades. And I think that's helped us. And it's also our view that every cycle is different. And I think post this correction, the new cycle that will emerge over the next 2-3 years, to our mind will be led by large caps and larger mid caps, not by micro caps and small caps.
Interesting. Just a behavioral question before we get into the mechanics. How easy it is to take a call to sell a company wherein you have the belief that the underlying business is great, and the whole thesis that so many people project about, when you buy a good company, hold it, doesn't matter, but hold it for a number of years. But here you are saying that you saw some overvaluation in select mid caps which are a part of your portfolio. You obviously love those companies, you love those managements, and yet you took a call, and a hard call, to sell them. How easy it is to take these calls and switch over to something that was not your first point of favor, but because valuations were compelling enough, you went and did that?
So again, Neeraj, I think that especially when it comes to small and mid caps, if you really want to be a long-term investor, right, you should know how to manage the volatility, right? So all our strategies are cap agnostic. So we have large, mid, and small exposure. We restrict the small cap exposure to a very small amount because of liquidity issues. But because markets keep changing character, for example, small and mid caps were very cheap in second half of 2013. They were actually trading at a 700 basis point discount to the Nifty, right? And here in Jan, they were trading at 2200 basis point premium. I mean, that's a massive re-rating that they had gone through. But so no matter how much you like them, everything is good at a price. And you have to look at the risk reward for the investor, right? I mean, it's great to say that we should be 5-year and 10-year invested in companies, and surely we have done that in many companies, where we've remained invested for 5+ years. But in the interim, you have to manage the volatility, and it is important that how much, because we do a lot of concentrated investing. Sometimes it makes sense to reduce our weight but still hold a core position in a stock that we like, right? So that's what we did in many of the stocks that we owned in the mid-cap space.
Okay. Somewhere in your answer, you mentioned that when this correction settles down and the next cycle starts, which would be a 2-3 year cycle, or will last or start over the next 2-3 years, whichever it was, large caps and larger mid caps will take center stage. Now, yes. What will, to your mind, mark the end of this corrective phase, if we haven't reached that already, and if it's possible to predict that?
It's very difficult to predict, whether we are at the end of the correction or the correction is already behind us. my experience has shown that usually the low points in the market is when the macro is at its worst. And I think the macro was at its worst in India when oil prices peaked at $85, $86, right? And so from there, we've seen oil correct very substantially. That's like a natural stimulus to the economy, right? And I think the peak of the crisis was IL&FS. And usually the highest risk aversion is during the peak of any crisis, right? So while it's difficult to predict what the exact bottom is, but if I were to go by past experience, I think we may have seen the worst in the markets just a couple of months ago.
Can the global factors come out and impact, or is it again too difficult to predict? Because frankly, who knows how Trump will behave, who knows how the trade war situation will be, and who knows how aggressive or less aggressive would the Fed be?
Absolutely. I think those are, so I think more than the domestic factors, what could queer that pitch is what happens globally as well, right? I think even the US markets, the kind of volatility that we are seeing, usually this kind of volatility is seen when some kind of a top or bottom is formed. So we've seen a very severe correction from the top in the US. Again, you know, it's not our job to predict tops and bottoms, but I think usually this kind of volatility precedes, you know, settling down and some kind of a bottom being formed. But there are imponderables going into 2019. We don't know what's going to happen, whether China and the US will settle the trade dispute. They have a deadline of March. Whether the Chinese economy will slow down dramatically, you know, there are an after effect, and whether the Fed will finally relent and talk the language that the markets want them to talk, right? But these are all imponderables going into 2019. I think as portfolio managers, our focus is to cut out all of this noise and just focus on companies which have durable earnings growth and where the risk reward is still favorable for investors to make money.
Yeah. Well, the only reason why I asked this was because I think an earlier guest mentioned once that as portfolio managers, we are so focused on finding good businesses that times we don't look at or overlook the macro. It comes and hits us hard, as it did in 2018 for once. But anyway, it seems to have settled, at least if that is the thesis.
Sure.
And let's work with that thesis, Hiren. Leave the imponderables out. Let's work with the thesis that the macro looks a lot more stable right now for 2019 for India. How are you going about and choosing the businesses? I got the broad drift that large caps and larger mid caps. Now within this framework, how are you going about and choosing businesses? Are the sectors, are the themes that you're choosing starkly different from pre-IL&FS?
See, I think what one, at least the way we are looking at our portfolio, is that there are certain secular growth stocks that we want to continue to own. Now, clearly, these are stocks that everybody knows are doing quite well, right? And therefore, it is hard to assume that there would be any PE multiple expansion that is possible there. So essentially, what you are playing for is earnings growth. And if you believe that there is visibility for earnings growth in those companies will compound at the rate at which earnings are compounding for them over the next couple of years. Then the real interesting challenge is to find companies where we think the balance sheets are very strong. These are relatively larger companies, but where they are doing something very specific, or we believe that the external environment for them is getting a little more favorable, and we think that the rate of change is likely to be significantly different, right? So let's say corporate banks, where we think that they're trading at cheaper multiples than, let's say, the retail bank, private sector banks are. Now, I'm not saying that retail private sector banks won't do well. They will continue to do well, but they are priced for the fact that they didn't have an NPA cycle, and the corporate banks were priced for the fact that they had to go through a very severe provision cycle in the past. So that's where the rate of change would be different, right? Or, for example, we recently invested in a capital goods company where the last time the peak earnings in that company were seen in FY12. and thereafter only we've seen a trough in earnings. And we believe that probably over the next 2 years is when they will potentially cross the previous peak that they achieved 8 years ago, right? I mean, almost in 2012, 6 years ago. So you have to look for companies which are generally well run, but have gone through a tough cycle, and where you think that whether the external environment is likely to improve for them, or they're doing something very specific to their strategy, where we think that the rate of change could result in a re-rating plus an earnings growth momentum. So I think the challenge now is to find those kind of ideas, because what is growing at 25-30% is already discovered and priced for it. And therefore, for you to make incrementally significant alpha might not be that much easy. But at the same time, if there is long-term growth in those companies, you want them in your portfolio, right? But you have, the challenge now is to be a little more innovative and look for certain non-consensus ideas in the large caps and larger mid caps where you think that incrementally money can be made.
Okay, so capital goods now, again, you could say the market-wide it's non-consensus, but a lot of smart money managers like yourself are probably already looking at that, right? A lot of people that I've met recently have said that if you classify markets into two buckets, and then industrials and capital goods look like coming back. Are you strictly non-consensus, or any pockets wherein you are a standout non-consensus investor in a large nature? There are some themes which are coming around and looking like taking shape and form, but don't quite have investments there, smaller ones. Where is it that you are completely anti-consensus?
So I think one stock in large cap where we've taken a slightly contrarian view and which looks interesting is Bajaj Auto, for example, right? In the two-wheeler space, people have preferred TVS or Hero Motors before, and really Bajaj hasn't done anything for the last several years in terms of stock price performance or incremental growth and profitability. If anything, they lost market share. But I think early this year they changed their strategy. They've gone after market share, and we are beginning to see that play out in the numbers where their domestic sales are picking up at the entry level, right? So I think that plus they have a fairly good exports market franchise that is also growing quite nicely. The three-wheeler business is a cash cow. They may be very early, they may be one of the first few very early entrants to introduce electric vehicle two-wheelers as well, as they have mentioned. And the stock was trading at 13-14 times 1 year forward when the entire market is trading at a substantial premium to that, right? So now nobody has priced the stock for growth, right? So and there are people who are still very skeptical. And I think, I'm not saying I will make money, but at least your probability, if your thesis is right, your hypothesis is right, is that your probability to make money is much higher in something like that than to bet on a consensus trade today and hope that you will make disproportionate money with quality. So I think, whether it is things like Bajaj Auto or whether it is the corporate banks, you have to have a good mix of the portfolio, because as they say that the leaders of every cycle is different. Right? So you don't have to be stuck with the leaders of the previous cycle. And there are some stocks which lead in every cycle, but those are a few exceptional companies. For the rest of the portfolio, you have to think hard and look at companies that you think will lead the next cycle. But again, I mean, I just use Bajaj Auto as an example. Yeah. I would request everybody to kind of, a disclaimer that we own it, and but they should consult their advisor and do their own research.
True. So I was looking at your portfolio, Hiren. This is not meant to be a stock discussion, but I was looking at your portfolio, and you are still invested in spaces which were kind of the leaders of the last few years, right? Financials and consumer discretionary. So in the strictest of senses, selectively within those buckets, you are still optimistic.
Oh yeah, I think for us, we don't think top down as to what weight we want in financials or consumer or whatever.
Okay.
It's the aggregation of what we have in the portfolio that shows up as the weight. So I mean, as I said, I mean, we may have reduced exposure somewhere in private financials but added some other exposure in private financials, so the net exposure probably remained same, but the structure of the exposure might have changed across names, right? But that continues to be a large opportunity, and there has been such a big dislocation, as everybody has mentioned, because of the PSU banks, that it's a great golden opportunity for some of these companies to take away market share.
And which will continue, you
And
believe?
which will continue because,
Okay.
We are still, relatively speaking, an under-leveraged economy. Corporates were over-leveraged, but consumers were still under-leveraged. They are getting more leverage now as we go ahead. And the corporate leverage cycle might also restart again, once the NPA cycle is away. So financials do offer a lot of opportunity. Consumer, whether discretionary or staples, there are a lot of companies which are very interesting there, and it's a natural area of growth in India, right? So there will always be some secular bets that you will continue to make there. And industrials, again, one of the learnings is that when you think that, there is a new area which is going to emerge, the idea is not to go headlong. So you kind of wet your toe in, you test out your hypothesis, and if the trend is long enough, it doesn't matter if you get in a little late, you don't have to be early all the time. But we think that there is a chance that selectively, in capital goods, in industrials, there is money to be made because, everybody has been so overweight all other sectors. But for us, it's purely a bottom-up stock call rather than a top-down sector call.
Okay, interesting. I want a couple of answers from you on the behavioral aspect of investing as well, but just one quick question since we're on the topic. Are NBFCs, which were largely the leaders of the last 3 years, if not the last 5 or 7, are NBFCs as a theme largely underweight now post ILFS? Because at that point of time, October, November, almost every NBFC company itself came and said that growth numbers for the next couple of quarters might look muted, and we don't quite know what FY20 would throw up.
Sure.
What's your thesis?
See, I think the way I look at the whole NBFC story is no different than other significant thematic moves that we've seen in the market from time to time, right? So I think version 1.0 of NBFCs is over. It culminated with the ILFS crisis. When I say 1.0, as in what happens is that you have a sector where every player is growing, and people in the initial phase do not differentiate between the good, the bad, and the ugly, right? To give you an example, so pre-2007, 8, when retail was a new industry in India, right? Everybody wanted to set up retail stores, and the market was giving valuations based on how many square feet you have. It's like giving you a valuation on eyeballs, giving you a valuation on square feet. Nobody bothered about inventory turns, margins, free cash flow. And then the sector went through a very difficult time period. And from there emerged version 2.0, which is the winners. So the guys who were doing the business the right way, who didn't get busted because of too much leverage on the balance sheet. And they, after a brief period of consolidation, the next survivors kind of broke out and then started to grow again. I think something pretty much is likely to happen in NBFCs as well. Version 1.0 is over. You just gave growth was the single biggest factor for premium, was at a premium. Nobody focused on what is the liability mix, whether there is an ALM mismatch, what is the underlying credit quality. Nobody was asking those second level questions. Now that the crisis has happened, I think the men and the boys will be separated. There may be a period of consolidation after the sector corrects so severely, but from there will emerge the leaders and they will continue to grow. So I think we are likely to see version 2.0 of the NBFC cycle. Version 1.0 is over, and you have to be very clear that you are with the 2.0 winners of that cycle rather than any of the 1.0 ones which might either not make it or will go into a long phase of correction and consolidation, right? So I think the sector will still grow. And like tech has grown post 2000, it's not that, but just imagine how many tech companies were there pre 2000 when 1.0 was being played out, and how many have survived and grown post that. The same, as I said, happened in retail. The same is going to happen in NBFCs.
So you may not be taking a bet, but are you kind of working with a hypothesis or a common strand or a distribution feature which will set apart the men from the boys in version 2.0? Would it be the collections that the NBFC has, or the ALM factors, or
No, everything. I think it's not just any one variable, right?
But that's always the case, right, Hiren?
Yeah, that's always the case. And look, I think what happens is that you get to understand these things only during a time of crisis, right? So as Buffett put it, that when the tide turns out, you know who's wearing clothes and who's not. And also what happens is that through successive cycles, whether these are regulatory headwinds or external headwinds or that is the time when these things show up in the numbers, and that is the time that the strategy, the execution is different than the vision, because everybody has the same vision. So if you look at the at a PowerPoint presentation of any NBFC company, they will say, oh, there is massive growth opportunity, there is so much under penetration, and there is blah blah blah. But the difference is not in the opportunity. Everybody understands that the opportunity exists. The differentiation is that how do you execute on that opportunity?
Yeah.
And how do you not get busted? By the time you go from being a small player to a significantly large player in that business. So the beauty is that in India, there is the external opportunity for all the businesses is so great, whether it is retailing, whether it is financial services, whether it is the consumer markets. But it's only over time that you are able to differentiate who is executing on that opportunity, not getting busted and, maintaining a certain growth rate, a certain discipline in capital allocation, in free cash flow. All these things come out. So I think to some extent, these are times when you have to look in the mirror and look at yourself and said that do you have the right bet, or it's still not too late to change your bets, because the version 2.0 will go on for a very, 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 very long time.
Sure.
And the better you are if you are sitting on the right horse than the wrong one.
That's true. Okay, my final question, Hiren, and maybe not for the concentrated portfolio, because there you have very selective bets, but when you're running a slightly larger portfolio, surely at a given point of time in 2018, there would have been companies which would have been losers.
Yes.
They wouldn't have done well. They would have been significantly or slightly below your purchase price or whatever it is. How easy or difficult has it been for you to take that hard call, if you've taken that even if the company is a loser and I'm losing money out here, let me get out of it and let me put that money into what is appearing to be a winner right now? Because it's just, as a behavior, very difficult to accept defeat, that the call that I've taken is wrong. And the belief for a lot of people would always be that the tide is turning. If not now, in 6 months' time, it will turn around and my stock will start performing. Have you had to take those calls in 2018, and how easy or difficult has it been?
I think we have, and good you brought this point up, because again, what happens is that when a stock falls, people tend to do one of the two things. Either they freeze and don't do anything about it, or they add to their investments. But there is a third thing you could do, and these things typically happen when you have a secular fall in the market, where the breadth of the market corrects, like which happened recently. And then you have alternative choices. So you say, okay, my stock has fallen, but there is something else that I didn't own, which has also fallen. Now, again, can I do a risk reward and say that probably this is a good time to switch from A to B? You don't do it for all the stocks, but you certainly do a critical analysis, because something that you liked may not have been cheap enough at that point in time, and therefore you bought something else. But now that everything has fallen, you have an opportunity to say, okay, this has also fallen and this has also fallen, but you know what, I wanted to buy B and I have A, and probably this is the time you can switch out, at least if not all, in some of your. So when the market goes into what I call as a reset mode, you have an opportunity to reset your portfolio as well a little bit, right? And where you think you have the conviction, well, you hold on, you add to your position, and you ride the volatility. I mean, that's the way to play it.
Okay. Words of wisdom. Hiren Ved, it's been a pleasure talking to you today. Thank you so much for taking the time out.
Thank you so much, Neeraj.
At some point of time, we'll talk about running and how running aids you in your investment process as well. But
sure.
Maybe we'll leave that for another day. For now, thanks so much for being here.
Thank you so much.
And viewers, thanks for tuning in to this broadcast of Alpha Moguls.